The IPO of the day, Peloton, opening at $27 a share. That's below the IPO price of $29, and it's struggling to hold on to $27 here. It's been a tougher landscape for IPOs these days. Nearly half of the year's offerings are down from their listing price. That includes names like Uber and Lyft, of course, but also Smile Direct Club and Slack. Have investors had enough with these money-losing startups? For our opening exchange today, I'm joined by Duncan Davidson. He's a partner at Bullpen Capital. Our own Bob Pisani is monitoring the situation at the New York Stock Exchange, and Sara Fischer is Axios media reporter with more on this story. Welcome to everybody. Duncan, let me just go to you first, because you said, look, there's a price at which you'd be a buyer of Peloton, but it's well below where we're trading at here.
This is an example where you're buying a stock and not a company. The company's terrific. The product's game-changing, but I'm probably more interested at $14 a share and not $27.
And why that number?
And you looked at the fundamentals. To really love this stock, you have to believe it's going to do what Uber did. Everybody had doubt about Uber when it first started growing. They said, oh, my God, it's got to take up so much of the cab market. This can never be a big company. What did it do? It grew the cab market by 3 to 5 times. You'd have to believe in the Peloton case, it's going to grow the gym market by 3 to 5 times. I think that's really hard because Uber was cheaper than a cab. Peloton is a high entry price.
Yeah, and Sarah, people have also, in the last couple of weeks, focused on a business model risk then, which is pretty major. It's their use of music for so many of these popular classes. They have a lawsuit now that's doubled to $300 million against them by 10 music publishers and artistic groups, saying they found 1,300 more songs that were used without permission. So in terms of business risks, this would seem like a pretty major one.
It's a huge business risk. Look, when people are going to invest $2,000 in a bike, $4,000 in a treadmill, and $40 a month on software, they need to enjoy the experience. And if they're not going to get the music that they want, they're not going to be able to grow a fitness market that's going to be 3 to 5x, to your point. The other thing, John Foley said this morning on CNBC, 34 million people own a treadmill but don't have their software. That's where the business opportunity is. But why is someone going to download a class if there's crappy remixes of the songs? And users are really angry about it right now. Yeah,
it's one of the main things you hear about because people are loyal with the service, but with that caveat being they love their music. Bob, this isn't just about Peloton's business model and challenges. This has been a very tough week and now a tough year for IPOs.
Yeah, and there's a lot of pushback on price. Your guest is right. It's not so much about whether the company is good or bad. It's a good company, but how much they're willing to pay for it. So, look, we had this problem with Smile Direct, priced above, trading way below that. WeWork didn't even make it out. Some of the software IPOs, high valuations, they've been coming down the last few days. Endeavor, which is supposed to price tomorrow, they lowered the price range just a couple hours ago. No, there's a very clear trend going on here. And I think what we're getting here is pushback from the buyers that are out there against companies that are losing money for the most part, and in fact, the private valuations are high. And I think that what we've got here is a misprice. The bankers obviously believe that the private valuations are what should be used in the public markets. And apparently, Kelly, the public markets do not agree with the bankers.
No, they don't. And Duncan, last time you were here, we talked about what you coined as SoftBank syndrome, the valuation issues plaguing WeWork, even the Lyft and some of the other names out there. Peloton is not a SoftBank name. What do you glean from this? Because, again, from Peloton's point of view, they might say, look, we raised over $1 billion at a pretty nice market cap. They might feel relatively okay about how this has gone.
This is not a SoftBank stock. I do think, though, that we're keeping these companies private way too long. And the unicorn rounds near the end for the IPO have been way overpriced. I'm a fan of getting these companies out public sooner. WeWork is an example where the public markets did their job even before it went public. They've cleaned up what was a horrible mess, or they're trying to.
Right.
Peloton, I think the story is a little bit different. Consumer stocks have not done as well in this cycle as B2B stocks. You could look at GoPro, Fitbit, I suppose, as extreme examples.
Right. What would you do to get them public sooner? What has to change in terms of the pressure?
Well, after the 2000 bubble, the wisdom of our leaders really screwed up the IPOs. They sort of blew up a whole ecosystem of small IPOs. It's hard to recreate an ecosystem. I think the SEC has been experimenting, but you've got to go all in and really set it up with a long-term view so you get a whole bunch of players back in. We should do this quickly, but given the current situation in Congress, I don't expect anything to happen.
Yeah, that's a good point. Bob, we'll give you the last word here.
One point is, one of the things I'm really wondering right now is if this continues, you get this pushback, how many companies who want to go public might opt for direct listings. It could be a major factor. It's obviously many companies need the money and they can't do a direct listing, but those who don't may find direct listings more palatable if this kind of pushback continues.
Okay, we'll see. Thank you guys. Appreciate it. Duncan Davidson, Bob Pisani, and Sara Fischer.